China's economy is growing at its slowest rate in nearly 3 decades. In the last few hours, the government there said that the world's second biggest economy grew by 6.6% last year. Now that comes amid a broader global slowdown and a trade war with the United States, whose effects are starting to be felt. Well, economic growth of 6.6% for the year as a whole in 2018 was broadly in line with what many had expected, but it is the slowest rate of expansion since 1990. But it fits pretty neatly with the government's target of growth of around 6.5%. Well, over the last decade, China's growth has slowed as the government tries to more carefully manage the economy. In fact, on Friday, the 2017 growth figure, that was actually revised downwards from 6.9% to 6.8%, so a gradual slowdown. The government in Beijing is worried about too sharp a slowdown and has therefore announced a string of measures to try and boost the economy. They did that last week, all of it including tax cuts, infrastructure spending, and an $84 billion cash injection to try and maintain consumer spending levels. Well, one of the big reasons that consumers are reluctant to do their spending is their growing amount of debt, something that has been rising pretty steadily over the last few years. So too has the debt held by companies, and China's collective debt is now almost equal to 3 times the size of the economy. Let's speak to Robin Brant, who is in Shanghai for us. And Robin, I mean, clearly a lot for all of us to keep a close eye on, but it is really a mark of a slowing economy, not one that has stalled.
No, I mean, there is a lot, as you've just covered there, to talk about, but I think what we're seeing here is further proof that China's economy is now in an expected slowdown. The trend of growth continues to slow, and the big question is how will the government manage that slowdown? What it wants is essentially a soft landing. Now, as you say, when we discuss these figures, there's always the caveat, and I think you've alluded to that just now, about how they always seem to be very close to government forecasts, if not actually bang on. And there is much suspicion here that actually growth in China's economy could be far, far less. But nonetheless, the trend is clear, and that is of a slowdown. There is particular concern about consumer demand. We had figures confirming a few weeks ago that the demand for new vehicles in China, it's the biggest car market in the world, well, that fell by 6% in 2018. That's the first fall in 20 years. And remind ourselves as well of a warning from the man in charge of Apple, Tim Cook, just a few weeks ago, saying that demand for Apple's products here in China towards the end of 2018 had fallen so significantly that it's going to have an instant impact on revenues for that company. The key question, though, as I've said, is the extent to which this is a managed slowdown, and the government can help to not so much orchestrate but manage a gradual slowdown, because stability, particularly when it comes to unemployment here and the threat of rising unemployment, is the big focus for the government.
Yeah, and we know the government very willing to step in to try to manage that slowdown, as you touched on there. We talked about the cash injection, we talked about some of the spending on infrastructure investment, but there are a lot of things that are outside the control of the Chinese authorities, not least that trade war with the United States.
Yeah, I mean, there are two things. That even if you doubt the figures, there is clear evidence from President Xi Jinping down that the government knows there is a serious problem it has to deal with, because we have evidence of a stimulus of sorts. Before Christmas, a big meeting of the Communist Party leadership. We've got changes to the technical aspects of how much money banks have to keep. The government's trying to pump a bit more money, a bit more liquidity, a bit more credit into the system. We've got some tax cuts coming as well, and we've got some new initiatives to encourage provincial government here. They're a key lever of the economy to spend more money on infrastructure projects. The problem is China doesn't have as much wiggle room, so to speak, on that stimulus as it had 10 years ago, say after the global financial crisis. The other factor, you're right, is the trade war. You know, we're about halfway through now this 90-day period for the US and China to try and agree some kind of deal to see off a further escalation in tariffs. And what that's led to in terms of trade is a really negative sentiment, a real fear about the future, and that's having an instant impact, it would seem, particularly on consumer demand.
Yeah, absolutely. Robin, thank you. As always, good to see you there, Robin Brant in Shanghai for us.